1929 was a prelude. 2008 was a grim warning. But the coming event is not merely a crash, it is a deterministic implosion. Equities, real estate, digital assets, sovereign debt, all distorted by unified malfeasance. This is the bubble of everything. And when the apex of leverage is breached, fiat currency will offer no sanctuary. This is the macro threshold, and we unveil the only three assets engineered to survive the zero sequence. The time for sanitized reporting is over. We have entered the era of the unvarnished truth, where the failures of centrally managed finance cease to be theoretical risks and become cold mathematical certainties. For years, the global economic matrix has operated under a fraudulent premise that debt can be perpetually expanded without consequence, and that systemic fragility can be managed by the creation of infinite liquidity. This is not fear-mongering. This is the authoritative analysis of the structural rot beneath the veneer of modern prosperity. Macro threshold exists not to predict the precise hour of the deluge, but to provide the schematics for survival when the walls inevitably fail. This is the only actionable path left to those who understand the true geometry of the coming systemic collapse. The countdown has reached its terminal stage, marked by the perverse synchronicity of the implosion, the unavoidable consequence of the everything bubble. Central banking policy, defined by successive waves of quantitative easing and the theoretical lunacy of modern monetary theory, did not stimulate organic growth. It simply fabricated a universal correlation. Trillions of injected dollars flowed into every single available financial vessel simultaneously, resulting in a market where the valuation of technology stocks, long-duration fixed income, and suburban tract housing moves in chilling 100% lockstep. The lie of diversification died the moment the Federal Reserve decided to eliminate risk pricing entirely. This time, there is no sanctuary. In previous cycles, capital could rotate from risky equities into treasuries or from compromised sovereigns into robust commercial property. But the sovereign debt market is now the epicenter of the crisis, structurally compromised by the very mechanisms meant to prevent instability. When the inevitable panic sell-off begins, the correlated market structure guarantees that every exit door will be sealed simultaneously. The cascading failure will be unified, violent, and complete. To ignore the trajectory of current events is to willfully ignore history, which dictates that financial delusion operates under the immutable rule of three, a repeating cycle of manic ascent, followed by stochastic chaos. We observe three concise examples of systemic bubbles that underscore the virulent nature of crowd delusion and its eventual devastating resolution. First, the Dutch tulip mania of the 1630s, a testament not merely to flower speculation, but to the calculus of popular hysteria. At its peak, a single Semper Augustus bulb traded for more than the cost of a grand house on the Amsterdam canals. The collapse, swift and total, proved that perceived scarcity married to mass psychological contagion creates hypervelocity valuation that can vanish faster than light. Secondly, we examine Japan's 1989 asset bubble, a cautionary tale of sovereign intervention failure. Japanese real estate reached such heights that the land beneath the imperial palace was theoretically worth more than the entirety of California. When the bubble finally ruptured, the government's attempts to inflate its way back to solvency only locked the economy into 3 decades of stagnation. The devastating velocity of capital destruction transmuted into generational economic purge. Finally, the 1998 Russian ruble crisis, a stark reminder of geopolitical risk as the flashpoint catalyst. A seemingly contained emerging market default, coupled with falling commodity prices, spiraled into a crisis that threatened the solvency of major global banking institutions, most notably long-term capital management. The lesson is clear. A localized credit event, when married to immense leverage, can trigger a destructive feedback loop across the entire financial architecture, evaporating massive wealth overnight. Today, the bubble thermometer flashes red, displaying ignored financial indices that demand attention. The empirical data proves we are not merely in a cycle of high valuation, we are in clinical denial of reality. The Shiller price earnings ratio, or CAPE, which adjusts for cyclical earnings volatility, currently tracks at levels rivaling both the height of the 1929 Great Crash and the peak of the 2000 dot-com frenzy. This index is not subjective. It is the fundamental measure of whether asset prices bear any relation to underlying profitability. They do not. Furthermore, the inverted yield curve, where short-term debt yields more than long-term debt, is sounding the definitive warning. This pattern is not a suggestion of recession. It is a perfect historical harbinger, having preceded every major economic contraction since the 1970s. The banking system is effectively signaling a catastrophic future loss of confidence. But perhaps the most insidious threat is the explosive proliferation of zombie debt. These are corporations, often massive public-facing entities, that are unable to service the interest payments on their massive leverage using operational profits alone. They survive purely by rolling over debt or issuing new paper, dependent entirely on the continuation of near-zero interest rates. When rates normalize or credit tightens, these zombies are the fuel for the inevitable chain reaction of corporate defaults that will break the system. The disaster chronology is defined by the zero sequence, the inevitable path where paper wealth fails entirely. This sequence begins with step 1, the credit trigger. This will be an unexpected major corporate or sovereign default, perhaps a heavily leveraged European financial institution, or a critical emerging market entity whose dollar-denominated debt becomes unserviceable. This singular event will shatter the illusion of unified central bank control. Step 2, the forced deleveraging. The trigger event forces margin calls on a global scale. Investment banks and hedge funds must liquidate their least desired yet still valuable assets to cover losses on their illiquid toxic holdings. This flood of forced selling creates the catastrophic feedback loop, driving prices lower and generating further margin calls in an unstoppable downward spiral. Step 3, the liquidity blackout. As systemic distrust peaks, the financial matrix freezes entirely. Interbank lending ceases, and the velocity of money collapses. While this intense deflationary pressure crushes the value of all risk assets, the central banks, fearful of depression, will unleash hyper-aggressive, desperate monetary stimulus, ensuring that physical fiat depreciates rapidly even as asset values plummet. This is the moment fiat currency offers no sanctuary. To navigate this deterministic implosion, preparation must be absolute, focused only on assets designed to withstand the zero sequence. We have isolated the only 3 survival assets engineered for this environment. The first is a historical hedge against monetary debasement, a fundamentally scarce, physically verifiable asset, mined from the earth, which cannot be digitally printed or inflated away by sovereign whim. Its value is divorced from the modern fractional reserve system and serves as the ultimate store of value when confidence in government-backed paper is entirely lost. The second survival asset is the fundamental building block of productive output, strategic, non-financialized land, and the self-sustaining infrastructure necessary to utilize it. This is wealth based on immutable physical reality, not counterparty risk. The third survival asset is a decentralized, digitally scarce mechanism designed to exist entirely outside the perimeter of sovereign monetary control. It is a mathematical proof of value, verifiable on an immutable ledger, engineered specifically to resist the inflationary impulse of failing central banks and the inevitable capital controls imposed by desperate governments. It serves as a superior bearer instrument, allowing for the transfer of significant wealth across borders and jurisdictions instantaneously, entirely devoid of counterparty risk or the systemic vulnerability inherent in the fractional reserve system. If the first 2 assets protect against the physical debasement of currency and the loss of functional infrastructure, the third asset ensures transactional liquidity and the preservation of numerical value during a global financial seizure. These 3 pillars, physical scarcity, real productivity, and decentralized digital verification, form the totality of the macro threshold survival architecture. This is not investment advice in the traditional sense. This is the framework for wealth preservation against a deterministic economic implosion that has already begun. The era of comfortable delusion is over. This is the unvarnished truth of the coming deluge, delivered only by macro threshold. Section 1, the countdown. We enter the final cycle, distinguished by a unique synchronicity of risk unparalleled in modern history. The Federal Reserve, followed by every major central bank, spent the last 15 years pursuing policies, quantitative easing, and its explicit successor, modern monetary theory, which achieved their primary goal, the total neutralization of price discovery. By artificially injecting vast, unprecedented tranches of liquidity into the financial system, they successfully fabricated a universal correlation coefficient across every major asset class. Equity valuations, long-term sovereign fixed income, residential and commercial real estate, private equity, and even many commodities now move in lockstep. This is the definition of the everything bubble, a structural failure engineered by design. In previous downturns, capital found sanctuary. When equities collapsed, bond prices typically rose, providing a hedge. When the domestic market faltered, international exposure sometimes insulated portfolios. This time, however, there is no sanctuary. The liquidity flood ensured that all boats rose together, artificially binding disparate risk profiles into a single, monolithic, hyper-leveraged structure. When the tide of liquidity recedes, every asset class tied to the zero interest rate paradigm will fall simultaneously, guaranteeing mass capital destruction without a single traditional safe haven available to buffer the shock. The traditional 60-40 portfolio is not just obsolete, it is a guaranteed vehicle for symmetrical collapse. Section 2, the rule of 3. History offers cold, objective proof that modern man consistently miscalculates two critical variables during a systemic bubble: the calculus of mass hysteria and the velocity of panic. The mechanisms shift, but the outcome, the sudden irreversible destruction of paper wealth, remains constant. Consider the Dutch tulip mania of the 1630s. What began as a rational appreciation for a biological rarity quickly devolved into pure speculative delusion, where the price of a single bulb could exceed the annual income of an affluent merchant. The crash was swift, driven by the realization that the underlying asset possessed no productive utility sufficient to justify its pricing. Capital evaporation was total, illustrating the dangers of pricing based solely on the greater fool theory. Jump forward to the Japanese asset bubble of 1989. Fueled by ultra-cheap credit and land mania, the combined value of Tokyo real estate supposedly exceeded the value of all land in the continental United States. When the Bank of Japan eventually tightened policy, the result was not a quick correction, but a decades-long balance sheet recession. This historical example confirms that sovereign intervention, when implemented too late or poorly managed, does not halt implosion. It merely guarantees permanent economic stagnation and generational debt overhang. Finally, examine the Russian ruble crisis of 1998, triggered not purely by domestic financial excess, but by geopolitical contagion and the unexpected default on sovereign debt. The speed of the capital flight and the ensuing devaluation demonstrated how nonlinear risk, an unexpected flashpoint, can instantly translate paper wealth into dust. This crisis cascaded globally, nearly taking down the entire U.S. fixed income market via the collapse of long-term capital management, LTCM, underscoring the interconnected fragility of highly leveraged global finance. These three examples, hysteria, stagnation, and geopolitical flashpoint, are merely historical echoes of the singular, magnified risks confronting us today. Section 3. The current diagnosis. The financial matrix signals danger through metrics that the mainstream apparatus willfully ignores, believing they possess superior ability to defy economic gravity. But the data remains absolute. The bubble thermometer is flashing red, registering values last seen only at the precipice of catastrophic deleveraging events. First, the Shiller Price earnings ratio, or CAPE. This cyclically adjusted metric attempts to normalize equity valuations by referencing earnings averaged over 10 years, mitigating short-term manipulation. Currently, the KP ratio tracks levels only surpassed during the 1929 market peak and the 2000 dot-com bubble peak. It indicates systemic overvaluation that demands reversion to the mean, a reversion that historically requires equity indices to fall by 50% or more. Second, we have the inverted yield curve, a phenomenon where the interest rate on short-term government debt exceeds the rate on long-term debt. This metric has a perfect predictive track record, anticipating every major recessionary cycle in the last 50 years. The inversion signals that investors anticipate aggressive monetary easing, rate cuts, in the near future to counteract a severe economic downturn, indicating a profound lack of confidence in long-term growth. Finally, the explosive proliferation of what is coldly defined as zombie debt. These are corporations, many of them household names, that are fundamentally unable to service the interest payments on their massive existing debt from current profits. They survive only by perpetually rolling over their liabilities at continuously low interest rates. As the cost of credit rises, these zombies face immediate, simultaneous bankruptcy, representing trillions in corporate obligations, and guaranteeing a mass default wave that will break the shadow banking system and cascade rapidly into the regulated banking sector. The indic are empirical, undeniable, and universally ignored by those invested in the status quo narrative. Section 4, the disaster. Chronology. The implosion will not be a gradual decline. It will follow the zero sequence, a predefined chronology of capital destruction triggered by a singular credit event. Step 1, the credit trigger. The sequence begins with an unexpected massive default, not necessarily a sovereign nation, but perhaps a major corporate titan or a globally exposed shadow banking entity. This default immediately compromises the collateral quality held across the interconnected web of derivatives and repurchase agreements. Confidence breaks instantly. Step 2, the forced deleveraging. The initial default triggers a global wave of margin calls, forcing institutions to liquidate assets indiscriminately to meet cash requirements. Because of the synchronized nature of the everything bubble, these fire sales accelerate the collapse across all asset classes simultaneously.